On June 1, 2026, Alphabet announced an $80 billion equity raise. It was the largest single stock issuance in U.S. corporate history. The move confused Wall Street. Companies usually issue that much new stock when they are desperate for cash. Alphabet already had over $120 billion sitting in the bank, plus massive operating cash flow coming in every quarter. The immediate market reaction was panic. Investors assumed this massive influx of shares was a sign of distress, a heavy burden that would dilute the value of their holdings in a mature advertising business. But Alphabet isn't playing defense. While other tech giants are burning cash to find a theoretical superintelligence, Google is stockpiling physical, industrial capital. This cash grab is a preemptive strike. They are buying the raw materials to establish absolute hardware dominance and secure control over the multi-hundred-billion-dollar AI infrastructure market. To understand why they need $80 billion, you have to look at the massive bottleneck crippling the rest of the industry. We call it the Nvidia tax. Right now, hyperscalers like Microsoft and Amazon are trapped. They are forced to pay massive premiums for scarce Nvidia graphics processing units to build out their AI data centers. That $80 billion is Alphabet buying its way out of the trap. It funds the mass production and global deployment of their own custom in-house chip, the TPU V7, codenamed Ironwood. This chart compares Ironwood against Nvidia's Blackwell GB200. At the bottom, Nvidia holds a slight edge in raw training, but at the top, Ironwood outperforms in performance per watt, supporting a pod scale of over 9,000 chips, drastically lowering energy requirements. Ironwood isn't designed to train massive models from scratch. It is specifically engineered to run inference, the high-volume, continuous processing required when AI models actually interact with users. By 2027, inference will make up the majority of AI computing. Dominating this specific, cost-efficient layer is how Alphabet plans to outlast its competitors. For the first time ever, Alphabet is opening up the TPU V7 to select outside enterprise customers. They are completely vertically integrating. They design the silicon, write the compiler software, and build the physical data center fabric, effectively controlling every layer of the compute stack. Google is moving beyond simply selling cloud software. They are operating as a merchant silicon landlord, renting out the physical engine of the AI economy. Enterprises are aggressively buying into this new model. This chart tracks the Google Cloud backlog. From the fourth quarter of 2025 to the first quarter of 2026, the value of contracted future revenue nearly doubled, hitting a massive $462 billion. That backlog surge shows that global enterprises and sovereign nations are desperate for an alternative to US-restricted Nvidia chips. They are actively contracting with Alphabet to secure their own independent AI infrastructure. The external sales are significant, but the internal financial impact of using Ironwood is even larger. By shedding the Nvidia premium, Alphabet cuts its internal rack costs by up to 55% compared to competitors buying off-the-shelf hardware. Over the next 2 years, that structural cost advantage is projected to push Google Cloud's operating margin from a baseline of 12% all the way up to 26%, matching the profitability of legacy cloud providers. If Alphabet captures 20% of the AI accelerator market, it generates tens of billions of dollars in new, high-margin revenue. Shedding the Nvidia tax raises Alphabet's profitability ceiling and forces the market to re-rate the business as an infrastructure utility. Taking a snapshot of early 2026, this pie chart shows a business still heavily dependent on digital real estate. The massive green and red sections show search and YouTube ads, making up the vast majority of Alphabet's revenue. But while the ad business is mature and stable, Google Cloud is exploding with a 63% year-over-year growth rate. Projecting forward to 2027, the physical business pivot takes shape. As you can see, the blue Google Cloud section expands to 28%, visually compressing the share of ad revenue. Search and YouTube haven't lost their value. They have simply been repositioned as the structural cash cows required to fund this massive infrastructure build-out. This $80 billion raise turned Alphabet's balance sheet into a massive compute grid, shifting their primary identity from advertising to the physical infrastructure of AI.